Hey there, welcome to Tallied. I'm Kiran, and in today's video, we are going to see what accounts to prepare after the process account and how to prepare them.
This is our third topic from the chapter, Process Costing. As of now, we have covered the basics of process costing and how to prepare a process account. In today's video, we are going to learn how to prepare the normal loss account, abnormal gain account, and costing profit and loss account, along with the process account.
After watching this video, don't forget to take the quiz in the description below. If you understand this video and are able to answer all the questions in the quiz, then you are clear with this topic. After giving the quiz, you will find the solution to all the questions. So you can check if you got them all right or where to improve. And I almost forgot, 3 random highest scorers will get a mention in my future videos. So pay attention till the very end. The agenda for this video. By the end of this topic, you will be able to prepare a process account, a normal loss account, an abnormal loss and gain account, and the costing profit and loss account. I'm going to be solving these questions and I will go in a pace where you can solve along with me. So feel free to pause the video when required and solve with me. The timestamps for this video are in the description below to help navigate yourself. So let's get started with the first question. The following particulars for process 2 are given. You can look at this table for the information. The factory overhead in process is absorbed at 400% of the direct materials. Allowance for normal loss is 20% of units worked. The scrap value is rupees 5 per unit. We need to prepare the process 2 account, normal wastage account, and abnormal effective account. So here, normal wastage account is nothing but our normal loss account, and abnormal effective account is nothing but our abnormal gain account. Since this is the first question, we will also be solving the process account. So here, we are preparing the process 2 account. So we know that there has been a process 1, and we also know that the output of process 1 is going to be the input of process 2. So as given in the question, transfer from previous process is going to be the output or finished goods of process 1, which is being transferred to the process account 2. So we will account for this as 2 process 1 account, 4,000 units amounting to 9,000. Next, we have direct wages. So our direct wages is given as 2,000 rupees. And we know wages does not increase our output. So there will be nothing in the units column. Then we have direct material. Direct material amounts to 3,000 as given in the question. Next, we have factory overheads. So it says factory overheads is absorbed at 400% of direct materials. So 400% of 3,000. 400% of 3,000 is going to give us 12,000. Now let's move on to normal loss. So it says normal loss is 20% of units worked. So units worked is our input of units, which is 4,000. So we have by normal loss units equal to 20% of 4,000, which is 800. Now for the amount or normal loss realization, the question says the scrap value is rupees 5 per unit. So to get the realization, we are going to multiply 800 into 5, which gives us 4,000. Next, the question has given us that transfer to finished stock from the process is 3,240. So this is our finished goods. So by finished goods, 3,240. Now let's tally the units on both sides to see if the account tallies. So on summing the debit side, we get an amount of 4,000, and on the credit side, we get 4,040. So we see there's a difference of 40. So this is going to be an abnormal gain. So abnormal gain we account for on the debit side. So we have an abnormal gain of 40 units. Now, to find out the cost per unit or the amounts for abnormal gain and finished goods, we need to calculate the cost per unit. So the cost per unit formula is total cost minus normal loss realization divided by input minus normal loss units. So our total cost is going to be the sum of amounts on the debit side. So these are all our expenses, which gives us our total cost, which is 26,000. Next, we have calculated that our normal loss realization is 4,000 rupees, and we divide this by input, which is 4,000 units, minus normal loss units, which is 800, to get 22,000 divided by 3,200, which is 6.875. So this is our cost per unit. Now to get our abnormal gain value, we are going to multiply 40 into 6.875. We get 275. Next, to find finished goods, we're going to multiply the number of units into the cost per unit. Now, let's tally the credit side, or let's sum the credit side to see if the account tallies. And yes, this process 2 account has tallied. Next, we will move on to the normal loss account. So the normal loss account format is the same as a process account. We have particulars units rupees, particulars units in rupees. So first, we have to transfer the normal loss from process 2 account to our normal loss account. And since on the process 2 account, it shows up on the credit side, and our normal loss account is going to be on the debit side. We will account for this as 2 process 2 account. The units and the amount will be the same as it is the same transaction. Now, before we go on to the next step, there is something that we need to understand. So how does an abnormal gain occur? If you have watched my first video on introduction and basics of process costing, then you know this. So in brief, let me tell you this. Our input is 4,000 units. So I'm going to write that here. And our output is 3,240 units. Now the difference between this is our loss, right? Because we put in 4,000 units, we're coming out with 3,240. So what didn't make it is our loss. So this difference is going to be 760. But now, what is the loss that we have mentioned in our account? It's 800. I'm going to write this here. So now this difference, 760 and 800, is the difference of the abnormal gain. So abnormal gain is nothing but the difference between the estimated loss and the actual loss. So we have estimated a loss for 800, but there has been a loss of only 760, which gives us a gain of 40 units. Now, we need to understand that when we go to realize the scrap, okay, realize the normal loss. So we try to sell these scraps at a lower value. So now we assume that they are going to be 800 units and we will get 5 rupees for each of these units and we will get a scrap value of 4,000. But this is not the case because 40 units turned out to be good. So those don't come under scrap. We have only 760 units, which is going to realize any money. So let's account for these. So on the credit side, we have by abnormal gain and we have by cash. So by abnormal gain is going to be the 40 units. So for these 40 units, we expected to get 5 rupees per unit. So 40 into 5. So 200 we expected to get, but we are not going to get as this is not a scrap. Now the remaining 760 is the actual scrap for which we are going to realize some money value or cash. So here I'm going to write 760 and the amount is going to be 760 into 5, 3,800. Now we're going to tally this account. So we have summed this account and we see that it tallies. So let's try to understand this account. So we saw that normal loss has been transferred from process 2 to the normal loss account. Now out of this 800 units, not all of it is actually a loss. 40 of it has turned out to be proper or usable goods. So the remaining 760 is only going to be scrap and realized money value. So we account for it as buy cash 760 into the scrap value. Now the remaining, we do not have the scrap for these 40 units and we are not going to realize this 200 as a scrap value. We will see more about the abnormal gain when we do the abnormal gain account. So now the format for abnormal gain account is the same. We have particulars units rupees, particulars units rupees. Before that, let's make this again clear. These 800 units, not all of it is going to realize cash value. Some of it will, which is the 760 unit. And as for the abnormal gain, we do not. So this money that we expected to realize and don't is kind of a loss. So on our abnormal gain account, because this is some kind of a loss, the money we expected but did not make, because this is some kind of a loss, we are going to write this on the debit side. And this transaction is nothing but from the normal loss account. So on the normal loss account, we have it as by abnormal gain. So on the abnormal gain account, we will mention this as to normal loss account. And the units and the amount will be the same as it is the same transaction. Next, from our process account, we have this. So to abnormal gain will be written as by process 2 account. And the units and the amount will be the same. So now we have transferred from process 2 account to abnormal gain account. And we know that these goods are going to go on to become finished goods because they're not a scrap. They're not the normal loss. These are good goods that are going to go on to become finished goods. So if you've noticed, when we calculated the amount or value for the abnormal gain, we took the cost per unit, same as the cost per unit for our finished goods. But now we need to know that there is also some kind of a loss or an expense of 200, which we assume to make, but we did not. Okay, so the remaining is going to be our net profit. So this is transferred to our costing P&L account. So the difference is 275 minus 200, which is going to be 75. Let me summarize this again. So we know that the abnormal gain goods is going to go on to become finished goods. So we calculate the value or amount of this abnormal gain with cost per unit. So this helps us arrive at 275, but also there is an expense or a loss of 200, which we estimated or assumed to get, but we don't because no scrap is realized. Now the remaining is 75. This is going to be our net gain. So this is going to be transferred to our costing profit and loss account. So now let's sum this account. As we have already got the balancing figure of 75, this account also tallies. So this is the end of Our first question. In our first question, we have covered how to prepare the normal loss account and the abnormal gain account. But stick around for the second question because now we will see how to prepare the abnormal loss account. We will also see what happens to the normal loss account when there is an abnormal loss and an abnormal gain. And finally, we will learn how to prepare the costing profit and loss account. So this is our second question. A product passes through three processes A, B, and C. The details of expenses incurred on the three processes during the year were as under. You can refer to the table for the particulars and values. Management expense during the year were rupees 80,000 and selling expenses were rupees 50,000. These are not allocable to the processes. Actual output of the three processes were A. 9,300 units, B. 5,400 units, and C. 2,100 units. Two-thirds of the output of process A and one-half of the output of process B was passed on to the next process, and the balance was sold. The entire output of process C was sold. The normal loss of the three processes calculated on the input of every process was process A 5%, B 15%, and C 20%. The loss of process A was sold at rupees 2 per unit, that of B at rupees 5 per unit, and of process C at rupees 10 per unit. Prepare the three process accounts and the profit and loss account. But for this question, we will also be solving the normal loss account, abnormal loss account, and abnormal gain account. So first, we have our process A account. Units introduced 10,000 at a cost of 100 per unit. So this is our raw materials introduced. Next, we have our sundry materials. So sundry materials for process A is given as 10,000. Next, we have labor. Labor for process A is given as 30,000. And finally, we have direct expenses, which amounts to 6,000 rupees. Selling price for each process is given, but we will not use this yet. Management expenses during the year and selling expenses are given, but the question also mentions that these are not allocable to the processes. So since they're not allocable to the processes, we cannot show these expenses in our process account, but we will see what to do with these expenses later on in the question. Now let's go on to find our normal loss. So normal loss for process A is given as 5% of input. This is going to be 5% of 10,000, which is 500. The question also says that the loss of process A will be sold at rupees 2 per unit. So this is going to be 500 into 2. 1,000 is our normal loss realization. Next, we have our output. The output for process A is 9,300 units. But we also know that only two-thirds of the output is going to be transferred to the next process, and the remaining will be sold. Let's see how to account for this. So the amount that is going to be transferred to the next process will be accounted for under by process B account. And the remaining that we're going to sell, we will account for as by costing P&L account. So what is going to be transferred to the next process is 2/3 of 9,300, and the remaining 1/3 is going to be sold. Let's quickly calculate these values. 2/3 of 9,300 is 6,200, and 1/3 of 9,300 is equal to 3,100. So 6,200 units are going to be transferred to the next process, while the remaining 3,100 units is going to be sold. Now, let's sum our units on both sides to find out if we have an abnormal loss or an abnormal gain. So we notice that our credit side is short by 200. This means there is an abnormal loss. So we write this as by abnormal loss. And the units will be the difference between both these values. So 10,000 minus 9,800 is 200. Now, to find the values of abnormal loss and our output, which includes the output being transferred to the next process and the output being sold, we will use the cost per unit formula. So the cost per unit formula is total cost minus normal loss realization divided by input minus normal loss units. So our total cost is going to be the sum of our debit side, which amounts to 10 lakhs and 46,000. Our normal loss realization is 1,000. We divide this by input minus normal loss. So that's going to be 10,000 minus 500. By doing this, we get the cost per unit as 110. Now let's go on to multiply 110 with the units to find our abnormal loss and output. Let's sum the credit side to see if this account tallies. On summing the credit side, we have got a sum of 10 lakhs 46,000, which is the same as the debit side. So this account is tallied and we can move on to the next process account. So this is going to be our process B account. So to our process B account, we will transfer only what is being transferred to the next process, which is 6,200 units and not what is being sold. What is being sold will be transferred to the costing profit and loss account. So this we will account to as to process A account 6,200 units at 6,82,000. Now that we have got a hang of our process account, I will be going slightly faster with process B. So we have our sundry materials, 15,000. We have our labor, 80,000. And finally, our direct expenses, 18,150. With this, we're done with our debit side and we move on to our credit side to find our normal loss. Normal loss for process B is given as 15%. So this is going to be 15% of 6,200. We also know that the scrap or the loss of process B is sold at rupees 5 per unit. So to find normal loss realization, we're going to multiply 930 with 5 rupees. Similar to the previous process, we are now going to take our output. So output for process B is 5,400 units. And we know that half of the output for process B is passed on to the next process and the remaining is sold. So this means we have process C account half of 5,400 and the remaining half is going to go to our costing P&L account. Let's quickly calculate these values. Now let's sum our units to find out if we have an abnormal loss or an abnormal gain. So on the debit side, we get a sum of 6,200, and on the credit side, we get a sum of 6,330. So this time our credit side is more than the debit side, which means this is the case of an abnormal gain. We account for this as two abnormal gain, and the units will be the difference, which is 6,330 minus 6,200, which is 130 units. Now we go on to find the cost per unit. By using the same formula, we get our cost per unit as 150. So we will quickly multiply 150 with our number of units to find our abnormal gain and output. Let's sum the credit side to see if our account tallies. And yes, our account has tallied. Now for process C, I want you to try this process C account on your own. So you need to know what is being transferred to process C. So 2,700 units at 4,05,000 rupees. Now I will show you the question so that you can pause the video and try solve process C on your own. Once you are done, you can resume the video and we will continue to learn how to prepare the loss accounts, gain account, and costing profit and loss account. So this is our question. You can feel free to pause the video and try process C on your own. I will be showing you the solution in a bit. Now, if you're done with process C, let's take a look if you got it right. And in case you had trouble solving for process C, then I would request you to take a look at my previous video on how to prepare a process account. So this will help you understand all that you need to know in preparing a process account. So this is process C and our working note for cost per unit. So we have an abnormal loss of 60 units at an amount of 13,800 in process C. If you got this right, let's move on to prepare our normal loss account. Here we have our normal loss account, and first we will transfer our normal loss from all three process accounts. So from our first process account, we have a normal loss of 500 units at an amount of 1,000. So this will be accounted as to process A account, 500 units at an amount of 1,000. Similarly, we will do the same for the remaining two processes. So we have to 930 at 4,650. And for process C, our normal loss is 540 at 5,400. Now, you know what to do in case there is an abnormal gain, but our process A and process C have an abnormal loss. So what will we do with these values? Before we go on to that, let me explain this with a few numbers. So let's say our normal loss is 800 units. So our normal loss is nothing but our estimated loss. So in a year or in a period, we estimate that there will be a loss of 800 units. But let's say the actual loss turns out to be only 600 units. Then in this case, we have an abnormal gain of 200 units. Now let's say the actual loss was 1,000 units. So in this case, Our loss is more than what we expected. So this difference will become our abnormal loss. So this will be an abnormal loss of 200. Now, what we need to know in this is when we go to realize our scrap, in case of abnormal gain, we do not have these 800 units. We have only 600 units. So we will get the scrap realization only for 600 units. But in case of our abnormal loss, the entire 800 units will realize a scrap value because our abnormal loss is over that of the normal loss. So here we will realize the entire cash for 800 units. Similarly, if we have to account for this in our question, in process A and process C, we have an abnormal loss. So we will realize the entire cash value for these two processes. So we will write this as by cash 500 units at an amount of 1000. So we are just copying this value from to process A account to by cash account. Now for process B, you know what to do. Process B is an abnormal gain. So this means that we are not going to get the entire cash because only 600 units are actual scrap and will realize a scrap value. So we have by abnormal gain account, the number of units that will not realize scrap. So in process B, we have an abnormal gain of 130 units. And we know the scrap value in process B is rupees 5. So 130 into 5 is 650, which we will not realize. And the remaining is what we will realize as cash value. So this is going to be accounted as by cash for process B. The remaining 800 units at the value of 5 per unit. And finally, for process C, we will take the entire value because this is the case of an abnormal loss, and we will realize the entire cash value for our normal loss. So let's sum this account to see if it tallies. Yes, it tallies, and this is the end of our normal loss account. Let's move on to prepare our abnormal loss account. Now our abnormal loss account has the same format, which is particulars units rupees, particulars units rupees. So first, let's transfer our abnormal loss from process A and process C. So from process A, we have an abnormal loss of 200 units valued at 22,000. So this we will show on the debit side as to process A, 200 units valued at 22,000. Next, in process C, we have an abnormal loss of 60 units valued at 13,800. 60 units valued at 13,800, and this will go in to process C. Now, it is important to understand that in case of an abnormal loss, even these extra 200 units will realize a scrap value. So our normal loss of 800 realizes a scrap value, and we assume that even these 200 units of abnormal loss will realize a scrap value unless mentioned otherwise. So here we are going to mention by cash 200 units of abnormal loss from our process A and the scrap value of rupees 2 for process A. Now, you may wonder that if our abnormal loss also realizes a cash value, then why isn't it shown in the process account like we show the normal loss realization? The answer for this is that our abnormal loss does not affect our cost per unit, but our normal loss affects our cost per unit. This is because normal loss is borne by the customer and abnormal loss is borne by the business itself. So to understand this better, I would request you to watch my first video in this chapter, that is Introduction and Basics to Process Costing. And now, as I said, the business is going to bear the abnormal loss. So after the scrap realizes value, the remaining loss will be transferred to our costing P&L account. And we will account for this as by costing P&L account and enter the value of the difference of 22,000 minus 400, or what we realize in scrap. Similarly, we will do the same for our process C. So we realize a scrap value of 10 rupees for 60 units. So this is going to be 60 units valued at 600. Now the remaining loss is going to be borne by the business and transferred to our costing P&L account. So we will show this as by costing P&L, and again we will do 13,800 minus 600. Now let's sum this account to see if it tallies. This account has tallied. Let me briefly explain this abnormal loss account once again. So first, we transfer our abnormal loss from our process accounts to our abnormal loss account. So this will be shown as to process A account and to process C account on our debit side. Next is we need to know that our abnormal loss also realizes a scrap value. So based on the scrap value of our respective process, we realize a scrap value even for our abnormal loss. So we show this as by cash, the number of units of abnormal loss into a scrap value of that particular process. So by doing this, for process A, we get by cash 200 units valued at 400. Now we need to know that this doesn't show in our process account because abnormal loss does not affect our cost per unit. The reason for this is that abnormal loss is borne by the business while normal loss is borne by the customer. So because abnormal loss is borne by the business, it is a loss and it is transferred to our costing profit and loss account. So apart from what we realize in cash, the remaining amount of the loss is transferred to our costing P&L. So we show this by writing by costing P&L account and write the value of the remaining amount. So this will be 22,000 minus 400. We do the same for our process C because process A and process C are the accounts that had an abnormal loss. Now let's move on to our abnormal gain account. So we have already seen how to prepare the abnormal gain account in our previous question. So I will not be emphasizing on it this time. So first, we transfer our abnormal gain from our process account. So since we have two abnormal gain, we will write by process B account in our abnormal gain account. By process B, we have 130 units valued at 19,500. We have just copied the value from process B account. Next, there is also a transaction in our normal loss account where it says by abnormal gain account. So this will show as to normal loss account. To normal loss account, 130 units valued at 650. After this, the balance or the gain is transferred to our costing P&L. So again here, we will find the difference between 19,500 and 650, and this will be transferred to our costing P&L. So in our abnormal loss account, we transfer our loss to the costing P&L account, and in our abnormal gain account, we transfer our gain to our costing P&L account. So the gain is shown as to costing P&L and the loss is shown as by costing P&L on the credit side. Now let's sum this account to see if it tallies. And yes, it tallies. Now let's move on to our final account, which is the costing profit and loss account. So the format for costing P&L account is particulars units rupees, particulars units rupees. So the format is going to be easy to remember because this is going to be the same for our process account, normal loss account, abnormal gain account, and costing profit and loss account. So our first step is going to be transferring all the sales that we mentioned in our process account to our costing P&L account. So in process A account, we have by costing P&L account 3,100 units at 3,41,000. This will be accounted for as to process A account. Similarly, we will do the same for process B and process C. So for process B, we have units of sales as 2,700 and a value of 4,05,000. And finally, for process C, we have units as 2,100 and a value of 4,83,000. Next, if you remember, in our question, it had also mentioned that there is an expense of 80,000 for management and a selling expense of 50,000. And since these were not allocable to the processes, we didn't take them in the process account. These expenses will be shown in our costing profit and loss account. So on the debit side, we will account for these expenses as two management expense and two selling expense. So we have two management expense and two selling expense. So our management expense is 80,000 and our selling expense is 50,000. Next, from our abnormal loss account, we have by costing P&L account for process A, and we also have by costing P&L account for process C. So I'm going to mention these as two abnormal loss account, and I'm going to mention it separately for process A and process C. But you can add these values also, but here I'm going to mention them separately so that it is better understood. So we have two abnormal loss, 21,600, and two abnormal loss for process C, 13,200. Now, on our credit side, we will write our sales. So our sales, so we write by sales, and under sales, we have sales for process A, process B, and process C. Now, in our question, we are given the selling price for all these processes. So the selling price for process A is 120, the selling price for process B is 165, and the selling price for process C is 250. So what we're going to do is take these units respectively for process A, B, and C. So for process A, we have 3,100 units. For process B, we have 2,700 units. And for process C, we have 2,100 units. So the selling price for process A is 120. So our amount will be 3,100 into 120. Similarly, for process B, we're going to multiply 2,700 into our selling price of 165. And finally, for process C, we are given that our selling price is 250. So we will multiply 250 with 2,100 to get 5,25,000. So these are our sales values. So on the debit side, what we have is our cost for these units. And on the credit side, we have the sales values. So I'm quickly going to mention the selling price for all the three processes. Next, we also have a two costing P&L in our abnormal gain account. So this will be shown as by abnormal gain account. And this is for process B, and our value will be 18,850. Now, let's sum both sides to see if we have a net loss or a net profit. So on summing both sides, we see that our debit side is more than our credit side. This means we have a net loss. So we will account for this as by net loss. So our net loss is going to be the difference, which is 13,93,800 minus 13,61,350. So we get a net loss of 32,450. So with this, we have completed our costing profit and loss account, and we are done with our second question. The questions and solutions for the two problems we solved today are in the description below for you to refer and download anytime. In today's video, we have learned how to prepare the normal loss account, abnormal loss and gain account, and the costing profit and loss account. In the next video, we are going to see the equivalent production questions using FIFO method or the first in, first out method. I'm trying to help as many people as I can with my videos, and for it to reach those people, please do share it with anyone you think might benefit. Also, do subscribe to my channel. You liking and subscribing will help me make more such videos and grow on YouTube. Finally, for the cherry on top, a quiz that will help revise and summarize everything we have learned in today's video. 3 random higher scorers will get a chance to get a mention in my future videos. Find the quiz in the description below. Thank you for watching, and I hope you have understood this topic. I will see you all very soon.